Hello there, everybody. I am going to review a few problems for our final exam in this video. And the problems we're going to cover mostly deal with cost accounting and economics. So for our very first test, we had a lot of technical problems coming from quantitative finance. So we're going to have problems that we're going to work through. Maybe they're not quite as detailed as the finance problems, and really more we want to concentrate on the concepts behind the process of calculating the numbers, as opposed to really memorizing any kind of process of doing any one particular problem. So what I'm going to do here is talk about some general problems that you might see on the CPA exam concerning cost accounting and economics. And hopefully, as you study these problems and the concepts from your study guide, this will give you a greater appreciation of all the different types of questions that you could possibly encounter regarding these different topics. So the first thing I want to jump into is a couple questions regarding cost accounting, and really kind of stressing some basic ideas from cost accounting. And I want to note that, when you're working through your homeworks, there's a lot of different problems. Some are very simple, some are quite complex, some you had to jump into Excel to kind of work through. So those were all trying to prepare you for the different types of problems you might see on the CPA exam and the BEC portion. Of course, there's a lot of different potential types of questions because we are studying so many different areas for this particular exam. For the final test in our class itself, I'm really concentrating on kind of basic problems. So you don't need to memorize how to do every problem that you've seen on your homework. Really concentrate on those problems from this video and also the ones on the study guide. If I have something listed on the study guide, know how to calculate or analyze some type of situation, that's a problem that you need to know how to work through. So if you see it on the study guide or in this review, those are really the problems you want to concentrate on. And of course, I encourage you to go through that study guide for every term or concept on there. Go back into the books and try to read where it comes from. Understand everything there is to know about that particular concept for your final exam. So I've broken down the study guide by what particular text it came from, so that gives you an idea of where you can go and find that information. So on to these cost accounting problems. The first one is looking at a company's Sonor systems, and we're talking about machine maintenance here. So we're trying to figure out yearly expense for a machine, and this is going to include depreciation and any kind of variable cost associated with machinery. So maybe we have some type of equipment that we use for manufacturing, and we have the yearly depreciation, which of course comes from our initial purchase price. And in these problems, we're just telling what the yearly depreciation is. We're not necessarily getting into the method used to calculate it. So we're not talking about straight line or any of the other depreciation methods. You're just given a value for depreciation. You need to keep that in mind. That's going to be part of your maintenance expense. So for this particular problem here, we have a $20,000 depreciation amount, and we also have a cost of $2 for every hour we use the machine. So the depreciation is kind of accounting for the initial cost for the machine, spreading that out, of course, over several years. The $2 per hour, that's kind of the variable operating expenses that are associated with using that machine. So that's over and above what we're being charged for depreciation. So last year for this particular problem, we had 275,000 machine hours used, and we produced 10,000 units. The question we're looking at, if in the next year we anticipate that we have 300,000 machine hours used, or if we look at it from the perspective of last year, if we used the machine for 300,000 hours instead of 275, what would our maintenance cost be? So really not too difficult of a problem. What we're going to look at is just adding up all of our different costs. Well, the first one is $20,000. So even if we didn't use that machine at all this year, if we had 0 machine hours used, we'd still have a maintenance cost of $20,000 because depreciation is included in that calculation. Well, we do have that $20,000, but we also have that variable type cost. So we got the $2 per machine hour. Well, if we had 300,000 hours, we just take 2 times 300,000 to figure out that portion of the cost calculation. So we just got our 20,000 here plus our 600,000 for the second term. So altogether, we're going to have $620,000 worth of machine cost. All right, so we're just kind of delving into costs there, looking at the difference between kind of variable costs and fixed costs. So be aware of those concepts. Those are things you see over and over again in cost accounting. And also you'll see that kind of in the economics section when we talk about cost of production. So there's some overlap between some of these sections. Actually, if you recall from the last chapter we looked at for the cost accounting text, we actually talked about elasticity. We had a discussion board question that week about elasticity. Notice then the next week when we talked about economics, touched on elasticity again. So have some overlap, even though these are different disciplines that are being kind of tested on the BEC exam, there is some overlap there. So next question, again, we're kind of looking at fixed cost and kind of working a problem involving that. And notice this is a pretty simplistic problem. This wasn't very difficult. The math was kind of easy. The challenge is just setting it up correctly. The big challenge with that problem, realizing depreciation is kind of a fixed expense there, and realizing that we have the variable cost. So if it's variable, we're just going to kind of multiply it by whether the number of units, or in this case, the number of hours it takes to produce those units. So second question, we have fixed cost of $7 when we produce 25,000 units, and the fixed cost drops to $5 when we produce 35,000 units. And this is fixed cost per unit. Of course, the total fixed cost won't change. That's why it's a fixed cost. It stays the same. But if we're looking at it on a per unit basis, that's going to change based on how many units we produce. The reason is we have the total fixed cost that is it's a standard number. It's not going to vary. If we divide that by 35,000 units as opposed to 25,000 units, we're going to get a different value for the per unit cost. And that kind of gets to that idea of economies of scale. As we produce more stuff, our per unit cost goes down because we could spread those fixed costs out amongst more units. So that's kind of the concept we're looking at, the math required for this problem. We're trying to figure out what total fixed cost is when nothing is produced. All right, so basically, we're trying to figure out what total fixed costs are. So we're actually given more information than we need in this question. We can go about this in two different ways. So what I'm going to look at is, well, for the first one, $7 is our fixed cost per unit. So I need to think through, well, what is fixed cost per unit? How do I calculate that? Well, basically that's my total fixed cost divided by the number of units produced. All right, so we're looking for that total fixed costs. Well, I know here that in the first case, when it's 7, we had 25,000 units. All right, so notice now after we have that equation set up, it's pretty easy to solve for the total fixed cost. All right, just need to rearrange the equation. Of course, what we're going to do here is just take 25,000 times each side. So we have 7 times 25 grand equals total fixed costs. And if you run out the numbers there, it's going to be 175,000. All right, so that's our total amount of fixed costs. So when nothing is produced, that's still the total amount of fixed cost, right? That fixed cost amount doesn't change. Notice if I use the other information given, we'll get the same exact answer. All right. When we have 35,000 units produced, we're saying we have a fixed cost per unit of $5. So just the same setup, if I'd run the numbers like that, well, same idea. I could take the $5 times the 35,000, and that's going to give me my total fixed costs. All right, if I do that, again, we have 175,000 equals total fixed cost. And that has to be the case just by kind of the rules that underlie this process. All right, the total fixed cost is going to go down as we produce more. The reason this works out nice and cleanly in this case is because we're dealing with the same number here in the numerator. All right, so you would have arrived at the same number in either event. I just want to stress that relationship between fixed cost and production. Even when we're not producing anything, we're still going to have some level of fixed costs. Now, coming down to this next one, again, we're kind of talking about costs, but looking at variable costs. So this question's more focused on the variable cost. And the key element in this question is the idea of the variable cost ratio. And basically, this is what percentage of your sales price is comprised of variable costs. So let's say I sell a product for $100. And it cost me $70 in variable cost to produce that. I have a 70% variable cost ratio in that case. Now, that's not my total cost, right? That's just variable. We're also going to have some amount of fixed cost that we add in there. So for this particular company, we're selling a product for $50. We have that variable cost ratio of 45%, and we have total fixed cost of $68.75. So what we're doing here is trying to find the break-even point in sales dollars. And notice this is important. This is going to affect the last step of this process. So break-even analysis, something really important for managers, a concept that's really stressed on the CPA exam. So you'll probably see some type of questions like this. And the key idea here is with break-even, we want to set up an equation where we have the total amount coming in revenue equals costs. All right, that's where we're going to have the exact part where our profit equals zero. We're making just enough money to recuperate our cost. So we're trying to figure out what it is in sales dollars. Before we can get to that, we need to know how many units were actually sold. So we know when we sell each unit, we're getting $50 per unit, right? I'm going to use X as kind of my unknown variable here. So we're going to take $50 times X, and X just stands for the number of units sold. All right, so $50 times X, that's going to be my total revenue, right? Total revenue is just units sold times price per unit. So the break-even point is the number of units where my exact amount of revenue equals my cost exactly. So this is the revenue side. We need to set this equal to the other side of the equation for our costs. All right, so to do that, we know we have variable cost and fixed cost. Well, our variable costs are going to be this ratio, 0.45 times sales price. That tells me what percentage of my cost is variable cost. And notice we need to multiply that times the number of units sold. All right, so this whole term here, all this stuff together is going to be my variable cost at the break-even point. All right, well, we know our cost isn't just variable cost. We also have our fixed costs, so we put that in here as well. All right, so break-even is the point where our total revenue, which we have here, equals our total cost. Total cost are, right, our fixed costs plus those variable costs. So if we break down this calculation, all right, you can work through the math here. Basically, you're going to get X equals 250. All right, so 250 is the number that makes both sides equal. Now, that's the number of units sold. So if we sell exactly 250 units, our revenue exactly equals our cost. We break even at that point. Notice this question's asking for the break-even point in sales dollars. All right, so just a little extra step. Well, we know what sales dollars are because we have our units sold, 250, and we take that times how much we're selling each unit for. Well, our total sales in that case, we just multiply those numbers out, and that'll give it to us. And we should get 12,500, I believe, for that. All right, so break even, you're always trying to set up an equation where your revenue equals total revenue equals total cost. Now, these problems could be, displayed in different ways. In this case, right, our units were kind of the unknown variable. We could have different kind of holes in this model or different unknown variables, which changes the way the question's kind of worded and changes the dynamic of how you work through it, but the process is the same that underlies it. You want to set up that equation, you want to set up the two sides equal to each other and find the unknown variable. And of course, in this particular problem, we had a little extra step. We had to go from units to total sales dollars. All right, so I'm going to kind of move on from cost accounting. That's some of the basics, looking at fixed costs, variable costs, break-even points. And of course, you know, there's much more complex problems that could spring from that, but I'm going to kind of stick with the basics, make sure we're all on the same page for this exam. Same idea with economics. I want to talk about some of the basics, and we're going to look at supply and demand here. So all of you have seen this before in your econ classes. We worked through a week or so of looking at this stuff. So I want to go through a question here that looks at what's going to happen to the market for wheat if we have a drought in the Midwest, for example. So this is going to serve as kind of a springboard to talk about these types of problems in general. So we're looking at the market for wheat. What I'm going to do is draw a supply and demand analysis. And when you're working through your CPA exam or the final exam, you're not going to actually have to draw these supply and demand graphs. You've done this in your econ courses, no doubt, but you might want to do this on scratch paper, even though you don't have to actually draw the graphs. You might want to do this kind of on your own just to keep your thoughts straight. And these diagrams always start the same way. We kind of have the supply and demand curves lined up. We call this a Keynesian cross. Supply is upward sloping, demand downward sloping, and then we have our price and quantity. All right, so that's kind of the starting point. In these problems, you're going to be given some type of scenario. So something's going to happen in the market that either changes supply or demand, or potentially both if it's a more complex problem. And you're going to have to think through how this affects prices, how this affects quantity in the market. So if there is a drought in the Midwest, well, that means that less wheat's going to be produced, obviously. That affects producers, suppliers, so that's a change in supply. So that's the first part of the process. Whenever we have a problem like this, we need to figure out, does the supply curve move, or is it the demand curve that's going to shift? So think about who's being affected. The supply curve represents how much producers are going to produce of a product at different possible prices they could receive. Demand curve looks at consumers, how much they're going to buy of a product at different possible prices. So is this going to affect demand or supply? Well, in this case, producers can't produce as much wheat as they did before at different various prices. So that's going to be a constriction in supply. So once you know the supply curve's moving and once you know supply is being reduced, the next question is, what does that look like graphically? Well, we know when supply gets pushed back, the curve kind of moves upwards like this, which is a little confusing. And the reason I picked this particular problem is I think that's maybe the most confusing one intuitively. You think, well, supply is going down, so maybe my curve should kind of shift down like this. But actually, if you think about it, if supply gets reduced, if there's less wheat being produced, that's going to drive prices up. And notice that's what our analysis shows. We want to draw the intersection of the new curve with the original curve. So we have the original demand with the new supply, and just plot it out. Look at what happens to price. Well, we know the origin is 0, so as we move up, the number is getting higher. P2 is higher than P1, so price went up in this case. We do the same thing with quantity. Come down here, find the new intersection. Notice we're kind of going towards the left on the x-axis, so quantity has gone down. Price went up, quantity went down. That's usually what you'd expect to happen in a market when supply is constricted. Now, notice there's 4 different scenarios you could have. That's just one of them right there. So in this case, the supply of wheat went down, prices go up, quantity sold goes down. We could have the reverse case. So say supply increases. Well, in a case like that, we have the same starting point, but now that supply curve is going to push down to the right. So I have the same setup. Now maybe instead of a drought hitting the Midwest, let's say maybe they had really great weather all summer, good rain, just the right amount of sun, and they really had a bumper crop. Well, when that happens, supply actually increases. So we're going to see the curve moves in the opposite direction. All right, and then we got a new price point, a new quantity. All right, so in that case, price goes down, quantity goes up. So it's a good idea to have a general feel for which way the curves are moving given the different possibilities. With demand, same idea. If demand goes up, all right, we expect that prices are going to rise, right? If everybody all of a sudden has demand for this new product and it's really, really popular, well, you could expect that the companies can kind of get away with raising their prices. All right, so in that case, demand goes up. That demand curve is going to move. And notice it pushes out like this. All right, when demand increases, that curve moves over to the right. So we had our initial price, the new price, as we expected, price went up. And obviously, quantity sold is going to go up as well. If people demand more of it, producers can get a higher price. They're willing to produce more. Opposite case if demand goes down. All right, so and just intuitively, you can think about this. Well, what's going to happen with price if people have less demand for a product? Well, you know the price of that product should be expected to drop. That's why we see companies have discounts and offer coupons and stuff like that. They're trying to get rid of merchandise that wasn't selling at that original price. All right, so same idea, demand goes down. Now that demand curve kind of shifts back to the left. And notice price goes down. And kind of hard to see here, but quantity goes down as well. All right, so that's kind of an overview of the different type of processes you could have at play when we're dealing with those supply and demand questions. And just another thing to keep in mind that I see folks get tripped up on this a lot, the difference between kind of a change in demand and a change in quantity demanded. Notice in these two examples here, your demand curve actually shifted. We call that a change in demand because now consumers are demanding a different amount of those products at each possible price. So that's a change in demand. Notice your supply curve didn't move. We just kind of slid up and down the supply curve. We call that a change in quantity supplied. That's not technically a change in supply because our producers' behavior hasn't changed. They're still willing to produce as many units as before at different prices. Demand in the market changed, so their actual production changes, but their willingness to produce, which the supply curve indicates, hasn't changed. Notice in these two cases over here, the supply curve itself actually moved, right? That's called a change in supply. Demand didn't move in that case. We don't have a change in demand. We call this a change in quantity demanded, kind of sliding up and down the demand curve. All right, so that's a very subtle difference, change in demand versus change in quantity demanded, and change in supply versus change in quantity supplied, but really important difference that kind of underlies this whole theory of supply and demand. All right, so that's a very basic overview of some of these problems. Make sure you're aware of these different concepts behind cost accounting and economics. And also, of course, another section that'll be tested on the final exam is the kind of MIS, information technology stuff. Those questions aren't necessarily quantitative or math-based. I'm not going to review them here, but on your study guide, you do have some concepts and definitions from those chapters in that book, so make sure you're aware of that information, as well as all the conceptual and definition stuff from the cost accounting and economics sections as well. So I wish you best of luck on the exam. As always, if you have any questions, please let me know. Take care.